Hey everybody, today we'll be going through the next potential short squeeze. The concept has caught the public's attention with the news surrounding GameStop. Although I did not personally invest in GameStop, I 100% support the retail investors as well as the individuals on Wall Street bets who found this inefficiency in the stock and the severe amount of short trading that was happening with the stock. Retail investors can find inefficiencies and great investment opportunities just as much as the big hedge funds. So 100% back them up. And I'm glad they were able to find this inefficiency and be able to capitalize upon it. As always, if you're not subscribed to my page, make sure to hit that subscribe button below, crush the like button so that as many people as possible are able to see these videos, and leave a comment with your thoughts, whether you agree or disagree. Additionally, please sign up for my Patreon. You'll get insight into my watch list, my portfolio, live updates on research that I do on a daily basis, as well as instant posts when I buy and sell stocks each and every day. Today, we'll be discussing Ligand Pharmaceuticals, which I believe could potentially be the next big short squeeze. It's a biotech out of San Diego, California. It's a heavily shorted stock with about 60% of the shares shorted currently. I've been invested in the stock since it was trading at $70 in early 2019 and recently bought additional shares of the stock at $171. The company secures royalties and milestone payments with various partners by licensing out their technology. The company has over 130 partners. In early 2019, unfortunately, the company was heavily shorted by Citron and Andrew Left, which indicated that most, if not all, the company's potential revenue was from just 4 stocks. And that was kind of it. They were nothing else but those 4. If those 4 disappeared, then they would have no revenue. The company, in the coming months after that report was sent, the company sold their most significant revenue stream in early 2019 to Royalty Pharma for over $800 million. The revenue stream was giving them about $100 million in pure profit each year. They sold this revenue stream to Royalty Pharma, and they used additional funds to find even more partners than they had previously to be able to find more royalty streams. So we'll be going through their financial statements as well as their royalties and their partners. So stay tuned. We'll be going through the financials now. The company's financials overall from an income statement, balance sheet, and cash flow statement perspective look great. The company generates overwhelming majority of their financials quarter over quarter generate positive cash flow, as we can see when we go through the cash flow tab. In 2019, slight negative cash flow, but prior to that, significant cash flows. And then if we go into the quarterly cash flows, the last 3 quarters in 2020, even though they had negative cash flow in 2019, the last 3 quarters in 2020, they had positive cash flow from operations. So they're generating cash from their operations. In addition, the company's income statement, we can see that they have slight negative operating income, about negative 15 million, negative 15 million for the last 12 months. In 2019, it was about negative 5 million. If we go to the quarterly amounts, we can see the last 3 quarters, the company has had positive income from operations. With regards to net income, we can see that the majority of the negative net income, if there is, for example, in Q3, was due to taxes that the company, due to the taxes that the company had to pay, which resulted in the negative income. But prior to that, in Q2, they had positive net income, and again in Q1, they had negative net income due to. This was due to an equity investment that they have in Viking Therapeutics, which if the stock of the Viking goes down, then they have to record the loss. It's basically an accounting treatment. It's unrealized gain or loss. The company still holds those stocks and they haven't realized the gain or loss on those, but due to accounting codification, they have to recognize the loss each quarter. This is something that Berkshire Hathaway has to do as well, and so they always point to operating income as the basis for how their company is doing rather than net income due to this volatility, due to this equity method investment. So the company's financials look great from a balance sheet perspective. The company has significant assets, way more than their liabilities. Any liabilities that they have, for the most part, are long-term, so they're not due within the next year. They're due way out the long-term debt that the company has. And even so, the company has current assets, cash and equivalents, at the end of 2019 of over $1 billion. Currently, the company is valued at about $2 billion. So you can imagine that they're holding almost $1 billion in cash, which is half of their value. As of Q3 of this year, September, they were holding about $800 million in cash. With the cash that they generated from that deal, where they sold the revenue stream, they've been investing in additional partner royalties, as well as investing in buying back their stock. We can see here from this graph, their stock was trading at $70 a share, which the company thought was undervalued. So they were buying back shares in as many shares as they could at that time. And we can see recently that the stock has increased due to reports of a short squeeze, and that the stock has been heavily shorted for a while. But the company's been doing well, and they've been doing the same thing throughout. And in addition, they sold that revenue stream. They generated a lot of cash so that they could find additional royalty streams in the future. The company's positioned itself well, and in the future, they can continue to grow with those royalty streams as products go out to market, and they're able to collect those royalties from their partners. The company lists out their royalty streams on their website. We can see here they specifically keynote the royalties they currently receive. They receive royalties from Amgen, Arcotech, Sage, as well as Pfizer. And then they also disclose the percentages that they receive based off of the amount of sales that each of these partners have for the various programs or drugs that go out to market. In addition to that, they have listed an additional 31 different partners, as well as programs/drugs that the company's expected to potentially in the future receive royalties on. Again, this is 31 different programs that the company has an opportunity of potentially catching one drug where it just does really well. It explodes. It addresses a market and a niche that's really needed, and is able to generate a lot of sales. And the company is able to get single digit to potentially, in some cases, up to double digit royalties on that drug or program. So the company is set itself up very well to receive these royalties in the future. It continues to try to find deals and be able to sponsor and provide cash to these up and coming biotech startups that need cash and funding. And as a result of that, they'll give Ligand Pharmaceuticals milestone payments, upfront payments, or royalties for the money that they receive from Ligand Pharmaceuticals. So the company set itself up really well. I think the company was severely undervalued earlier in the year, and it continues to be undervalued. The company's all-time high was $252 per share in late 2018. So it's not even hit its all-time high at this point. I think it'll continue to grow. I'm invested in it, and I'll continue to hold on for the long term as this company does well and potentially progresses and finds some of these drugs that could potentially explode. So this is a long-term hold for me, and I hope you consider this and do your own due diligence on this stock. As always, make money, enjoy life. Peace.